You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Happy Monday, everyone. This is a little bit different this week. I ran out of time last week and was unable to record the podcast on Thursday or Friday as usual, so I'm a few days late, but still, happy Monday. Today's topic is going to be a little bit different. We're going to scan out to about 30,000 feet and talk a little bit about the long term and how important that is, and almost more importantly, how important it is to avoid the short term fluctuations and volatility and craziness in the stock market. And with how crazy the market's been this last few years, and considering the fact that I'm trying to lose my COVID weight and then some, I thought that a running analogy would make a lot of sense in terms of putting our retirement and income planning goals into focus today. But first, as always, a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness, and that's our mission. My hope is for you to learn a little bit more on each and every episode so that you become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often and feel free to subscribe both on iTunes and YouTube. In addition, you can follow me on Twitter at Adam Koós, and on Instagram at Financial Surgeon. And last but not least, all links, visuals, charts, and other educational resources are always available on our website, although today we really aren't going to have any big visuals, charts, or anything like that. This is going to be a very audio-heavy podcast. So if you're listening on iTunes, you don't even have to worry about looking for images today. So let's go ahead and get started. So the title today is Retirement's a Marathon, Not a Sprint. And what we want to talk all about is something that I said years ago in the middle of a client meeting. I was talking to someone and said, we just have to learn how to stop paying attention so closely to what the market's doing on a day-to-day or even month-to-month basis, and learn to keep our eyes on the horizon and not our feet. So as always, I like to start with some quotes. I've got a couple today, actually. The first one is Jackie Joyner Kersee. She said, "It's better to look ahead and prepare than it is to look back and regret." And I love this quote because although I think we all have regrets in our lives, I think that anybody who says they have no regrets at all, I don't want to say you're lying, but I would be one of those people. I can't count the number of times in my life where I've said I don't have any regrets. I don't regret anything. Everything I would say that every choice that I've made and every decision I've made in life has ended up for the best in the end, regardless of what that decision may have felt like at the time. And I do believe that. I do believe that every decision that I have made in my life ended up for the best today. Looking back, and that who knows what would have happened if I would have made a different decision in that situation. But the theme of today's podcast, again, is thinking long term. And, there's going to be times when the market behaves erratically. I started my career 10 days before the World Trade Center was attacked, and I can't think of a time in my 2 decades of doing this now at this point when the stock market has been stranger than it has been in the last few years, really. I've studied the market. I think this stuff's fun. I always say that, I haven't worked in 20 years because I really truly feel like I love what I do every single day when I wake up in the morning and start my day. But I've studied the markets, going back to London in the 1800s and the stock market crashed in the late 1800s. And no matter what the market throws at us or how crazy things get, there's 3 crucial keys to succeeding, whether you're planning for retirement or if you're planning your income or living in retirement and you're managing your expenses and your income. And here are the 3 keys. 1, we have to have a financial and retirement plan, or if you're retired, a retirement income plan. You have to. Otherwise, you're just investing and you're hoping you have enough. And hope is not a good strategy, obviously. The second key is implementing an investment strategy or combination of strategies that you believe in or that speak to you, that you really feel makes sense, because that leads us to the third key and really the most important one, which is sticking to the plan. Well, I should say the most important one's having a plan, because you can't stick to it if you don't have one. But sticking to that plan long term is key, and most people can't stick to their plans if they don't have a strategy inside that plan that they believe in or that speaks to them. And sometimes it takes more than one strategy. Sometimes it takes multiple layers. In our office we have everything from hedged investments to tactical portfolios to strategic portfolios that implement asset class, industry group, sector rotation. So there's lots of different ways to skin a cat, as the saying goes. And I also always like to say that no strategy works all the time, but over time any strategy will work. So the big question always becomes, what strategy can you stick to based on your personality, your tolerance for risk? And as much as I sit here and try to tell you to focus on the long term and not pay too close attention to the short term, some of you are just going to ignore me anyway. So in that situation, it makes sense for some people to have different mixes of strategies because they just can't help themselves. They just have to, build a spreadsheet every month or every day, worse yet. So my second quote, I kind of went off the rails there, my apologies, but my second quote today is Walt Mossberg. He was a journalist for the Wall Street Journal, and his quote goes like this. He says, "I see retirement as just another of these reinventions, another chance to do things and be a different, new version of myself." Now I'll read that again. "I see retirement as just another of these reinventions, another chance to do things and be a new version of myself." So, retirement shouldn't be, or retirement planning shouldn't be stressful. Retirement shouldn't be stressful, obviously. It should be fun. If you're focused on the stock market and looking at your statements and logging in online all the time, that's stressful. It's almost like your focus is so narrow that you're causing stress. And as the saying goes, anxiety breeds anxiety. So if you're somebody who gets a little anxious sometimes and that things have been a little bit crazy in the stock market, then probably the last thing you want to do is go looking at your investment statements in the short run, because it's just going to create more anxiety. The times you want to look at it might be when it's going up, not when it's going down, because unless you just don't believe in the American economy or the global economy for that matter, chances are it's temporary. Whatever setback we have is just a temporary setback. So let's go ahead and move into the meat of the material today. And probably one of the biggest things that when we boil down to these three keys, having a plan, sticking to that plan, having strategies, whether that's one, two, multiple strategies in your portfolio so you can stick to your plan. A lot of this boils down to trust. And there's this video that I recorded back, I think I'm trying to remember when I recorded this, 2012, 2011, I can't remember. But if you go way back into our old YouTube history, if you just go to YouTube and type in Libertas Wealth Management or Libertas Wealth, you'll find our page. And this video that I recorded kind of sums everything up. I don't want to go into detail on it because you can watch the video yourself. But if you're working with a professional money manager, a professional wealth manager, you need to work with someone who you trust, somebody you like. Once you've built your plan or strategy, it's going to have to be adjusted over time. There's times when you need to make changes, and that's part of the job of the wealth manager. That's not your job, unless of course you're feeling uneasy, you're not happy with the results that you're seeing. You might be in a portfolio that's too aggressive. You might be in a portfolio that's too conservative. You might be invested in a way that is too static, maybe too tactical. And maybe there's going to be changes that just need to be made over time. I've been doing this, like I said, 20 years, and I've never been working with any client over any period of time. Even our clients, going back to my very first client, who still works with me today, who I met on their doorstep in Grandview, Ohio. There has never been a client who I've worked with who we haven't made at least a couple changes to their strategy over time, because not only does the market change and not only do people's personalities change, but you change over your lifetime. When you get closer to retirement, your tolerance for how much risk you want to take changes. When you retire and you're no longer working anymore, you probably don't want to be nearly as aggressive, and you might want to take a different strategy on altogether. Maybe you don't want to be in the market all the time anymore, and you want to be more tactical. Whereas more recently, maybe you're somebody who you thought you wanted to be tactical, but the market's been moving so fast lately that you'd rather just be more strategic and static, and you want to stay in the market more. So all these things can be changed to adjust your portfolio to meet your plan's objectives So again, that third key, so you can stick to that plan. But at the end of the day, no matter what, you have to have, if you're working with a professional, you have to trust them, like them. You have to, it's kind of like having, your doctor, your surgeon, the attorney you work with, whoever it is in your life, your professionals, your CPA, you have to trust them. And if you're ever listening to this video or any of our videos and you're wondering, who can I trust? In this video here that I'm showing you on the PowerPoint, if you're watching on YouTube, and for those of you on iTunes, you don't need to see this, but all you need to do is go to this website. It's NAPFA.org, the National Association for Personal Financial Advisors. In this website, you can punch in your zip code, and it gives you all the fiduciaries close to you. So obviously, we're on that list because we're a fiduciary, financial planning, retirement planning, and investment management firm. But I'm trying to be unbiased here and say, the smartest thing to do is to interview a few professionals, figure out who you like, figure out who you can trust, and then from there, see how things go, make changes over time. And one other thing I'll throw in there is we're still the only financial advisory firm in Central Ohio to have ever won the Better Business Bureau Torch Award for Ethics and Trust, and we're really, really proud of that. So, and that kind of goes right along with that fiduciary word again, where you want to be working with somebody who is a fiduciary and who's got your best interests in mind. Think of it almost like a personal coach. You're the owner of the team. You're hiring a coach to help you kind of coach that team. Pick the assistant coaches, pick who sits, who starts, who's drafted, whether on offense or defense, and so on. So anyway, going off the rails again. So let me change gears. Let's talk about the stock market, and thinking long term. Obviously, it goes without saying, the stock market's volatile, right? I mean, it's up and down all the time. Nothing goes up in a straight line. If all the market did was go up in a very, very steady straight line, I don't know that I'd even have a job, honestly. I have 2 degrees. I have a finance degree and I have a psychology degree. So 2 bachelors of science in psychology and finance. And I always joke that I feel like I use the psychology degree more than I do the finance degree half the time, because again, so much of my job is about managing client emotions and helping our clients to stay focused on the things that matter and avoid the things that don't matter. So when we look back at the stock market, it's very temperamental. You look back at the 2000s, early 2000s. So between 2000 and 2002, you had this period of what I call low and slow, kind of like barbecue, where you've got this long period of time over 2 years back then, where the dot-com bubble burst, and the market goes down 47% over 2 years. So, you've got, you're in 3 months, 6 months, you're down in value. 9 months, you're down in value. At 12 months, you're down in value. 18 months, your portfolio is going down further. That is if you're in a strategic buy and hold portfolio, of course. And 24 months in, you're still down. You're still going down, I should say, before the market finally bottomed. When we look at 2007, 8, and 9, it was the same kind of thing. It was this low and slow drop, a little bit faster than 2000 through 2002, but the mortgage crisis caused this low and slow drop of 58%. So the market crashed. It went down 58% from top to bottom from October of 2007 to March of 2009. But again, it was, March of 2007, everybody's happy. October 2007, everybody's happy. Market's been doing well for 5 years. No real reason for concern, perceivably anyway. And then all of a sudden it's, 6 months later that your portfolio's down. And then another 3 months later, it's down further. A year into it, so in October of 2008, your portfolio's down, and then in November it just accelerates downward. So you're over a year into this decline, and it's just grinding lower, and it's so stressful, right? Because if for those of you listening, you've probably lived through this. You probably looked at your 401ks, your IRAs, Roth IRAs, brokerage accounts, trust accounts, and you probably saw your portfolio going down over the 18-month period until finally, a year and a half later, in March of 2009, it bottomed. After going down more than half the stock market, more than half, the 58% of the S&P's value was obliterated in that 18-month period. And it was a long time. 18 months doesn't sound like much right now, and I guess that's the point I'm trying to make here, is that 18 months, it's like, it's just 18 months. It's like, well, it's easy to say that now, because looking back, it's been, 13 years since it bottomed at this point, something like that, 12 years? So when we move forward, though, look at 2017. When you look back to 2017, for those of you who don't remember, it was a period of the lowest volatility that we've seen in recent history. In fact, I don't know that there was maybe 1 or 2 other years in history, in all of history, where the stock market had less volatility than 2017 did. So basically, I think the biggest drop in the market that year was 1.8%. Don't quote me on that, but I think that's what it was. In other words, the market never went down intraday, intra-month, or intra-year by any more than 1.8%, or at least I don't think it was more than 2%. There might have been one, I can't remember, but point being, there was no volatility. The thing just kept grinding northward. We call it low and slow, but in a good way. Call it high and slow, I guess. But anyway, so that was 2017. So then you had 2018, where the market goes down 20% in 59 days, and this ends up being the fastest, call it 19.9% drop since the drop that took place during Black Monday in 1987, and then the drop that took place during the initial decline during the Great Depression, obviously a long, long time ago. And then if that's not fast enough, you take a look at 2020 last year, where you have a drop during the COVID crash where the market goes down 34% in 22 days, which is the fastest drop in history, which is then followed by the fastest rebound in history at a positive return of 34% in 29 days. So the point again, the market is temperamental. It's volatile. It's really, and if you pay too close attention to everything that's going on a day-to-day basis, week-to-week basis, even a month-to-month basis, it will give you an ulcer, and it will cause you to abandon your plan. The plan that's going to get you to retirement, that's going to get you retired, and if you're already retired, it's going to cause you to abandon the plan that keeps you retired. We don't want to spend our golden years at the golden arches. Joke I heard a long time ago, and it's still funny today. But that's just, we have to stick to our plan, and let's talk about that next. So we all want the gains in the market, right? But we don't want the stress. We don't want the declines. We're all looking for that unicorn, that silver bullet. And I'm here to tell you it doesn't exist, unfortunately. You've got 2 different strategies you can use. You've got static, strategic strategies that are more buy and hold, but inside of these portfolios, it does well when the market goes up, but it stays in the market, and it invests in what I call the playoff teams. In other words, we're investing in let's just say there's a bunch of sectors and industry groups inside the market, things like building and construction, semiconductors, biotech, and all these different sectors and industry groups that exist. We want to invest in the ones that have the winning record. And as of late, we'll say in the last, call it 6 months or so, we want to invest in the strongest teams, the playoff teams, the teams that are making the playoffs on a year-to-year basis. And sometimes these teams are going to have, they're going to lose a game. Sometimes these teams are going to have losing streaks, and that's okay. Sometimes these teams are going to look like they're not going to make the playoffs, and then all of a sudden they rebound. The trick is, and this is obviously not your job as an investor, but our job as professionals, is to stick with the teams that are, even when things look bad in the short term, that on an intermediate term basis, they still look very, very strong, and they deserve a spot in our portfolio. But the risk management when it comes to static, strategic portfolio models are allocation based. So if you're in a static model, then your risk is going to be managed based on what percentage of money we're putting into stocks, bonds, currencies, commodities, cash, and so on. Obviously, if it's more conservative, we're going to have more bonds and cash. If it's going to be more aggressive, then we're going to have more money in domestic stocks, international stocks, and so on, commodities. Whereas tactical portfolios, so the other main type of strategy would be a tactical trend following model. This also does well. These models do well when the market goes up. Where they struggle is in a market that's very fast. And the trend following models are going to invest also in those same playoff teams. But we're trying to avoid catastrophic life-changing market crashes like 2000, 2001, 2002 that we were just talking about a second ago, where the market went down 47% over the course of 24 months, 2 years, or 2007, 8, and 9, where the market went down 58% over the course of 18 months. Another statistic that I didn't mention earlier is that when you look at the market back in 2000 at its high, when it went down that first time after the dot-com bubble, it did not get back to even until April of 2013. So in other words, break even was 13 years. Now, since then, things have been fine for the most part. There's been a lot of choppiness. There's been drops of 12%, 14%, 8% obviously corrections along the way, which are normal and healthy for the most part. But then there's been big drops like 2018, that 59-day drop of almost 20%. Then you've got the COVID crash, which was absolute insanity, 34% in 22 days, followed by positive 34% in 29 days. And this is all obviously during a time period when the economy's locked down, we're stuck at home, we can't go anywhere. So there's going to be times when strategic works, there's going to be times when tactical works, but like I said earlier, no strategy is going to work all the time, but all these strategies will work over time. You just have to pick the ones that make the most sense based on your age, based on your personality type, and based on where you are in terms of your financial plan output. So let's talk about when they work and when they don't work. I have, there's this saying, obviously, most of you probably heard this before, but, one man's trash is another man's treasure. So strategic portfolios, the ones that, stay in the market, they stay invested in the playoff teams, but they stay in the market all the time. We're rotating out of the bad teams into the playoff teams. We're rotating out of weakness and staying with strength, but they tend to perform really, really well when the market's going up. And then when the market goes down fast and up fast, they also tend to perform well. Because they never really get out of the market to begin with. Tactical portfolios, on the other hand, so trend following models, they tend to perform poorly during faster markets because the market's really choppy, and what ends up happening is you end up kind of buying low and then selling low and then buying high, because when the market goes down, you're trying to protect yourself against a long-term bear market or a long-term market crash, and then when the thing just comes screaming right back, you end up having to pay higher prices to get back in. Now, V bottoms that move that fast are not very frequent. They're not something you see a lot. Like I said, 2020, that was the fastest by far in history. There's nothing that looks like that if you go back in time. But at the same time, it's kind of like having snow tires versus summer tires. If you live in the northern U.S., in the Midwest, where I live, then there's going to be times when it's really, really snowy, and if you don't have an all-wheel drive car, if you don't have an SUV or front-wheel drive car, there's some times when people need to use snow tires, Blizzaks, I'm not getting paid to say it, but there's snow tires, brand-name snow tires out there that are great for use in the snow that help your car handle well. The problem with snow tires is if you have them in the summertime, it's so hot and the material in tires is so soft that they'll wear out super fast because they'll just melt these tires to nothing. But then you've got summer tires. Summer tires are really hard. They're made for kind of sticking to the road, and they're made of a tougher, harder compound. But the problem with summer tires, of course, is if you wear them in the winter in the snow, they're just going to slide like crazy, and you're not going to go anywhere, and you're probably going to slide all over the place, potentially get in an accident. So when you look at the strategic, static buy and hold portfolio models versus tactical trend following models, you're looking at something that's a little bit different, just like snow tires and summer tires. And to build a portfolio that can think of it like an all season or all weather portfolio, that would be combining the two strategies in some way, shape, or form. So I think that investors are either going to subscribe to something that's more, hey, you know what, I'm not going to look at my statements ever, I'm just going to throw it in the market. I want to be in all the time. I understand that it might go down a lot in a big, huge market crash, but I'm okay with that because I'm not retiring for a while, or I'm not going to spend the money for a while. And maybe when I get older, or maybe when I'm closer to retirement, at that point, I can look at maybe making a change either in allocation to a more conservative model within a strategic model, or I can make a change in split some of my money into a tactical trend following model, or all of it for that matter, at a time when it makes more sense. If I'm already retired, maybe I say, I don't have a big withdrawal rate. In other words, I'm not spending a lot of my money. So I'm okay having a heavier percentage of my portfolio in a static buy and hold model. Whereas another investor might say, I'm spending 4 to 5% per year, and I can't afford to have my portfolio go down 40%, 45, 50%. If we were to see, not if, but when we were to see another big, huge, catastrophic, life-changing market crash. So that investor might say, look, if I'm taking this kind of money out of my portfolio, I'd rather be more tactical. Maybe I have a little bit of money in strategic, but for the most part, I want to stay tactical because even if the market, I'm going to sum it up by saying I'd rather be out of the market wishing I were in than in the market wishing I were out. And that's the philosophy for somebody who's more of a trend following advocate. So let's talk about the marathon analogy. Obviously, it's sometimes fun to be in the market when it's going up. It's sometimes very frustrating, strange, like this past year, where things just don't make any sense at all. But most of us need to be invested in the stock market in some way, shape, or form. And when I say that, what I mean is that most people haven't saved enough money, even in retirement, in order to keep up with inflation and taxes without being invested in the market to help that growth take place over time. Especially when you look at our interest rate environment that we're living in right now, where today you're lucky if you can find a 4-year CD paying 1%, and then that CD, let's just say you take it out at the end and you've got your 1% you made per year. Well, now you got to pay taxes on it. So now you're taxed on the 1% gain, and then you got inflation sitting around 2.5% per year. And I think that that's a pretty conservative number right now when you consider how much government debt we have out there. So at some point, not to go off the rails here, but at some point we're going to have to figure out how to deal with this government debt that we have in our country, and it's going to be either A, by telling certain countries we're just not paying them back, or B, we're going to have to inflate our way out of it. And if we inflate our way out of it, then obviously inflation has to rise much higher than the 2 to 3%, more like 2 point something percent rate that we've seen throughout pretty much most of my life. I'm going to be 43 this year, and I don't really remember a time in my teenage and adult years here where inflation was any higher than 2 point something percent. And I imagine that'll probably change at some point down the road. So most people have to be invested in stocks or assets that help you not only keep up with inflation, but beat inflation in some cases. And then the second thing is understanding what long-term isn't. Long-term is not weeks. It's not months from now. It's not even a few years from now. One of the biggest misconceptions I hear a lot from, especially when before COVID, when I used to do investment classes and speaking engagements and things like that a lot, we'd have people in the crowd that would say something like, I only have, my time horizon is only 5 years. I'm retiring in 5 years. And it's like, well, your time horizon is not 5 years. You're retiring in 5 years, yeah, but you're not going to die in 5 years. You have to make this portfolio provide you with a paycheck now for the next 25, 30, 35, 40 years, perhaps. So your time horizon is not when you're going to quit working. Your time horizon is how long you're going to live, and how long do you need this money to work for you and to basically provide you with a paycheck. You're basically providing yourself with a paycheck to supplement your Social Security, and if you're fortunate enough to have a pension as well, then your pension as well. But long term is years, and your clock of life. So when we look at what happened this past year, what's happened this past few years even, and how crazy the market's been, we're only talking on if your life, the life you have remaining, is a 24-hour clock. For many of you, especially the baby boomers and the echo boomers, of course, or it's even more. But for many of you, your last few years are just an hour on the clock at most. So many of you have so much more time ahead of you, and I think that one of the biggest mistakes that people can make is looking at what the market's done or what strategies have done, combinations of strategies over the last few years, and say, well, you know what, I'm going to abandon my plan. I'm going to do something different. Because what can happen is you can change your strategy. This is important, by the way. I didn't write this down. I didn't think of this until now, but you can't keep chasing strategies based on whatever performed best the last few years. Because what will end up happening is you'll end up changing strategies at or close to the time when the old strategy starts working again. In fact, a couple of our clients have just said this recently. When we're talking about the strategic model as earlier, more buy and hold strategic, static models that we manage, as well as the tactical trend following models, the latter of the two have not performed well lately. And when I say lately, they haven't performed well in the last few years. So the tactical portfolio models, I was talking to a couple clients, completely separate people, separate families, and one of the things they said, well, I want to split some things up here, and I want to have a multifaceted strategy, but I don't want to go too heavy to the other side of the fence here, because what if now is the time when it's going to work? And I thought that was very wise on their part, because these are the things that I think and I say, but at the end of the day, again, especially those people who have maybe too much of a short-term focus have a tendency to kind of look at their portfolios and look at things on a month-to-month basis or a year-to-year basis and say, well, if it didn't work over the last 3 years, it's never going to work. And that's kind of like saying that, man, it's been raining for 3 weeks. I guess it's just going to rain forever. That doesn't make any sense at all. So like I said, every portfolio management strategy is going to have its strengths and its weaknesses. There's no such thing as perfect. It doesn't exist. But every portfolio management strategy is going to work over time, as long as it's not just a ridiculous strategy. Of course, I'm sure there's bad ones out there that have something to do with moon phases. There actually are strategies out there that have to do with space and stars and stuff like that, but not anything I subscribe to personally, but I digress. So speaking of space and stars and wind and weather, here's my analogy. I started this whole thing saying that retirement's a marathon, and if you've ever been in a race, whether that's a 5K, a 10K, half marathon, I've done the whole 10K thing before, and I don't want to do anything more than that. I'm, like I said, trying to lose my COVID weight here, but I'm not trying to destroy my joints, at least not for me, not my body style anyway. But anyway, so if we imagine that the wind and the weather is the stock market, okay, and then whenever it rains, if you've been in a race before, that it sucks. That if you've ever ran in a 5K and the wind is blowing in your face, it doesn't even have to be a strong wind. It can be 5-10 miles an hour. It's horrible. It's awful. But when that wind's at your back, or when you're running downhill, it feels so good. It feels like somebody's kind of helping to pick you up and push you along. But when you're running uphill, when the wind's in your face, it's so tough, and it makes things tough. And that's the stock market. The stock market can help you move faster. It can slow you down. And there's going to be times in your race of life when the stock market's going to create downpours. It's going to make you want to quit. It's going to make you want to abandon course and jump off the roadmap and just call your friend and say, hey, come pick me up, I'm done. But that's no way to finish your race or your route or roadmap, your retirement roadmap, so you can get to the end on time, which is not, again, retirement, it's the end of your life. Making sure you get from now to the end of your life where your money lives longer than you do. You have to stay on course, you have to stay on the road, and you have to keep running. And if you need coaching, if you need help, then you've always got that professional wealth manager, money manager, such as us at Libertas, to help hold your hand, be there for you, to hand you some water, and coach you along and motivate you and keep you doing what's best. Maybe you need to change your gait. Maybe you need to put a new hat on. Again, changing strategy here. I'm just making up analogies as I go. But the wind and the weather, if that's the market, then what matters really most is that you keep putting one foot in front of the other. In other words, if you're to make this analogy work really well, I like to talk about young investors. If you start your retirement planning, let's just say, even though the average person starts at 52, let's just say you're 25 and you're way ahead of the game. If you just invest your money a little bit and then you've grown a $100,000 portfolio and then you stop adding to it and you just want the market to take you to retirement, that's not going to happen. Putting one foot in front of the other, or in the race, the marathon of retirement, it's all about saving, managing your savings rate. And then when you retire, it's all about managing your withdrawal rate. And those two things are like putting one foot in front of the other. And if you just stand still and you let yourself get rained on, or if you go off course and you decide to quit and abandon your strategy, you're never going to make it. You can't. And unless, I shouldn't say that, unless you are just unbelievably wealthy. And when I say unbelievably wealthy, we're talking about the top 0.5% of the country. People who have so much money that it doesn't really matter. They could easily make it from now to the end of their life without ever running out of money. Even if they left their money in a 100% aggressive portfolio and they lost half. Even if they lost half their money, they'd be fine. But that's not the common investor. Even in our office, our office is not our clients are not a cross section of the economy. Our clients are a cross section of savers. These are people who've done well for themselves, who've saved throughout their lives, who are looking to retire soon or are already retired. These are people who own businesses that are looking to sell their business one day, or they've already sold their business and they're looking to save that money and provide themselves with a life after work. This is our client base, and so what we see are people who, generally speaking, need to be invested in the market. In other words, they need to be on that marathon track. They need to be putting one foot in front of the other. They need to be managing their savings rate, managing their withdrawal rate, and they also can't quit. Most people can't just leave the course and sit down and then hope that the weather's going to push them to the finish line, because that's just, again, it's probably not going to happen in most cases. So we want to focus again on the horizon, not our feet. We want to build a detailed, descriptive, comprehensive financial and retirement plan. You want to put one foot in front of the other, managing your savings. So if you're pre-retirement, before you retire, managing your savings, or if you're already retired, manage your spending at all times, no matter what the stock market throws at you. And then you need to make adjustments over time to your investment strategy. It's going to be dependent upon, these changes, I should say, are going to be dependent upon your personality, the results you've had, whether you're happy with them or not, your feeling about the market environment, the economy, how close you are to retirement, or if you're already retired. And then all these changes that happen throughout your life are going to change how you feel about risk, and it's going to require changes in your portfolio. Nobody sets up a financial plan at the age of 45, let's just say, invests their portfolio in an XYZ allocation and then just leaves it there until they're 90. Nobody does that. So you need to make changes over time, and they need to be changes that are well thought out, and they need to make sense based on the economy and the market landscape, of course. And then the most important thing of all, of course, as I've said over and over today, is you need to stick to the plan. And you got to stick to the plan. The number one reason that investors' financial plans fail is because of the investor. And the reason those plans fail is because they don't stick to the plan. And the number one reason they don't stick to the plan is because market volatility, risk, short-term temporary losses, and a lack of really understanding their own strategy and sticking to that strategy, or making changes to the strategy that they're comfortable with, is not something that they do. And so they just quit and they give up. And then or they continue chasing whatever the next best perceived strategy is based on the last 3 or 4 years' performance, which that doesn't make any sense either. So that's all I've got for you today. Feel free to share this episode with your friends and family if you'd like to discuss your personal situation further. Remember, you never have to be a client to ask a question. If you'd like to set up an introduction call or Zoom meeting, just head over to our website to schedule something on our calendar. As I always say, there's thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get not only these updates for our podcasts and video broadcasts, but you also our screencasts that come out quarterly, videos, articles, and other material that we write sent directly to your email inbox. Feel free to follow us on Facebook at facebook.com/Libertas Wealth. Again, I'm on Twitter at Adam Koos, as well as Instagram at Financial Surgeon. And thank you again so much for listening and hanging out with us today, and we'll look forward to seeing you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koos. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.